It's all getting a bit bumpy. The end of 2025 is being marked by the big stock market dilemma for investors. Have the AI investment plays of the past year run their course? Is it time to de-risk? Or could earnings, along with supportive fiscal and monetary policies, allow markets to sail into the new year? What are you hearing, Charlie?
I think there is excitement about the opportunities, but there's also anxiety around the AI bubble. So lots going on.
I'm Seb Morton-Clark, and this is Fidelity Answers, the series where we tackle the questions investors are asking of the people managing their money. And this month, if I'm worried about US tech, then where else can I make decent returns? Charlie Wood is head of UK institutional clients here at Fidelity. Charlie, this shift or this potential shift of capital, this is something that's on the minds of the investors you're talking to, is it?
Definitely. And I think that asset owners are worrying about lots of things at the moment. They're thinking about concentration risk. That's a big part of their thinking when they're allocating money. They've also got lots on their mind around policy changes, budgets, geopolitical risk, and of course the opportunity in AI. That's a really big area of interest with the clients and the investment consultants that we work with.
Well, we've brought into the studio today two of the sharpest stock pickers in Fidelity's portfolio manager toolbox. They both have investment approaches that perhaps might make us sleep a bit more soundly at night, and they're going to talk about some of the alternatives in equity markets that they're looking at. Fred Sykes is a European fund manager looking at a wide range of great opportunities in that region. Welcome, Fred.
Thank you.
And Tom Record spends his days weighing up the global options. So he's running strategies aimed at taking a bit more risk to maximise those stock market returns. Hello, Tom.
Hello.
So let's start with fundamentals, shall we? Because when it comes to the AI question, the big argument is all around valuations and concentration. Fred, if I can start with you, if we think about what you're seeing in the US at the moment compared to what we're seeing in Europe, we hear quite a lot about value being better over in Europe compared to the US. Is that an argument that you ascribe to at the moment?
Yes, I think if you look at the data, you can see an interesting divergence in leadership. So in the US market, growth is clearly in the ascendancy, and ex-US, interestingly, value has been leading in terms of investment style. And within the US market, it's primarily AI and AI-related investments that have contributed to that growth leadership.
So what happens if the AI bubble does pop?
Well, the first question is whether it is a bubble, because for there to be a bubble, there has to be sort of financial exuberance. And there certainly is quite a concentration of capex. I mean, you look at the spending plans for the next year, I think it's about sort of $500 billion, which is a huge amount of money. But this is being mostly spent by some of the most cash-generative businesses on the planet. So there is that capacity to spend. So on the hardware side, I think we should sort of accept that there is this capacity to spend. But we are starting to see more sort of debt structures coming in there. So I think that sort of amplifies to the upside and to the downside, both the opportunities and the risks.
I'm just going to throw that over then to you, Fred. How worried are you about a potential bubble here in the AI story? What could you see as happening further down the line if indeed that is what it turns out to be?
Yes, so I would say that it's an AI boom. I guess it's hard to know whether you're in a bubble, and really you can only ascertain that in retrospect. So, I think we have to be humble about what we perhaps do and don't know. I think, however, if that boom were to peter out, then I think it somewhat depends on how policymakers in the US would react. I think that depending on the severity of the slowdown, there would likely be interest rate cuts. And that would obviously affect interest rate sensitive businesses.
And if that is what ends up happening, what are the sort of the pockets of the market where you think it would be most sensible to be positioned for that eventuality?
I think a shorthand would be to look at the areas that haven't done very well in the last period of leadership. Those would tend to be unowned areas. The issue with that is that some of the fundamentals of those businesses are not particularly attractive. But there are pockets of opportunity, I think, in those more stable businesses, consumer-facing staples companies, for example.
I think that question about whether there's a boom or a bubble is quite pertinent, because no matter which one it is, you probably want to be on board. If we're in the early stage of a bubble, you probably want to be invested in it. But what you want to make sure is that you're not just invested in those stocks, because there will become a time when the cyclicality of, it might be a structural growth, but with a sort of moving around the trend, there will be waves to this, which we should exploit. And one of the things that you have at these moments where you have sort of, I suppose, everyone pulling in the same direction, is you have this sort of huge investment in an area. And we saw it with COVID, where we had biotech took leaps and advances that it otherwise wouldn't have done. Similarly, here we're seeing technological advances that I sort of think of it a bit like a sort of a science experiment, where you have that activation energy, that cost to get to the scale where it works, but you've got to sort of get over that hump. And at times of exuberance, you can get that because people are willing to invest, to lose money until you get over the hump, and then you can start making lots of money. And you can advance these new technologies that otherwise wouldn't come through.
It encourages a lot of volatility, though, doesn't it, in markets, as you're sort of trying to get over that hump, which is something we're sort of seeing at the moment.
It creates uncertainty. And there are questions as to whether uncertainty is good. I mean, it creates tension as well. And I'm a big believer that it's at these points of tension where there are bull and bear cases that value can be added through insightful analysis. And at Fidelity, that's what we do.
Fred, let me push you a little bit more on those areas of the market where there might be relatively less pain, or where it might be wise to be looking at the moment outside of those tech stories that we've all become so familiar with. You mentioned maybe sort of consumer staples, utilities. What other sectors have you been looking at over this year, or other pockets maybe in Europe this year that have been attracting you?
I think the other area that's interesting would be in financial services. So, one of the other characteristics that you see when a particular theme becomes very popular in markets is that it sucks capital away from nearly everything else. And that leads to relatively more attractive valuations. I think that would be particularly the case in a sector like insurance, where actually the fundamentals are, I would say, fair to improving, and valuations are fair to cheap. So that is an area where I would be looking.
And Fred, how do you work with the analyst on that sector? How does it work in terms of the discussing this topic with the research team?
So it's very much a collaboration, I would say. I think of myself as a generalist, and the analyst is a specialist. And, I come back to the idea that investing is very rarely black or white. It's shades of grey. And it's only really through, I find at least, it's only really through a conversation that you can build conviction and come to feeling whether you're more black or more white, where that shade of grey is on the spectrum. And that's really where the analyst comes in. So, we'll sit down and we'll think, what do we need to do to build conviction in this idea? Do we already know that information internally? Has someone else in the organization spoken to a supplier or competitor that can help us build up conviction in this theme? Or actually, is this a question that's outstanding, and how can we get closer to the answer? That might be running a survey, or meeting management, or meeting divisional management, whatever it takes really to try and build that level of conviction.
Is it quite a systematic process? I mean, do you have a checklist, for example, as you approach each company as a possibility?
Yes, I do use a checklist process. But I would say that one of the really interesting things about investing is it's not always the same things that are the most important. So at different stages of an investment life cycle, if you like, different things are more or less important. And part of the job of a portfolio manager is weighing those things differently over time.
It's a sort of micro approach, if you like, without as much attention maybe on sort of macro trends that are taking place. Does that mean that you have a risk of missing out on opportunities that might be driven by more kind of macro calls?
I guess there are two questions there. The first is around macro versus micro. And the way that I would think about that is, one kind of interesting observation is that I believe that supply is much more important for producing investment returns than demand. And you can actually see that if you look at the correlation between GDP growth and stock market returns over time. There's a very loose correlation. And that sometimes surprises people when they come to it for the first time. But actually, on reflection, that makes a lot of sense to me, because it's not actually GDP growth that drives corporate profits. It's the intersection of demand and supply. So you need an area of the market or an area of the economy where demand and supply are at least in balance to preserve profitability. If demand is running ahead of supply, that will result in increased profits. And conversely, you could have a very, very good demand environment. If supply is uncapped, then there'll be zero profit creation and therefore zero returns for shareholders. That perhaps is a bit of a long-winded way of saying that at Fidelity, I think that our value add comes from focusing on the supply side. The supply side is also generally slower moving and more structural. There are different explanations of that, of why that is. I think a lot of that is just down to human behavior. If people have invested in a certain area and they've lost their shirt, they're probably not going to go back and invest in that area for a while. And that lack of investment can create profitability, and profits drive stock market returns.
Tom, does that sound familiar to you? Is it a similar view that you take?
Yeah, there are a lot of similarities in that I think the way that Fred describes it is similar to our take on change. I mean, we believe that markets are inefficient, and that it's at those times of change that those inefficiencies and those behavioral errors that the market makes are most pronounced. I think that one of the differences for us is that we're deliberately broad, and to keep that breadth, we have three different pillars. We have a value pillar, a quality pillar, and a growth pillar. And similar to what Fred was saying, we look for different characteristics in each of those pillars, because for those stocks to perform well, they've got to perform. There are different elements that are going to be doing well. So if we look at the value pillar, for example, we're looking at stocks that are cheap, but where there's a change, a catalyst that will come through in the next 18 to 24 months that will drive earnings and profitability, but also therefore the multiple that the market's willing to pay for those earnings, and will therefore sort of lead to the sort of share price to return. The quality pillar, these are stocks where we're looking for compounding returns, strong competitive advantage that will enable a company to continue to grow and compound for longer than the market expects. So beating the fade might be another way of describing it. And then our growth pillar, which is sort of where I get sometimes most excited, and Chris, my co-manager, is very good at tempering my enthusiasm, is looking for that structural change that can come through, whether that be demographics, whether that be new industries, whether that be disruptors, and identifying companies with a strong competitive advantage that can seize that and compound over a long period of time, typically 5+ years, but very aware that to benefit from that, you will get ups and downs, and it's not going to be a straight line. So using the volatility to top and tail those long-term holdings.
Style is something that's really important to clients and asset owners, and we're always thinking about, which style is at the fore. And I know that with the pillars that you are managing, you are blending those styles. How do you think about that?
The overall style profile is pretty flat, actually, but what we want to see, and what we've seen actually this year, is at the beginning of the year when value was sort of driving returns, then our value stocks from that pillar were really driving returns. Liberation Day came and the market collapsed, and it was those quality names in the quality pillar that held up well and actually provided some ballast that we could use to reinvest into some of the other pillars. And then since then, we've had growth on a bit of a tear. So those growth names that we own have really driven returns for the strategy.
We want to get into a bit more of the sort of opportunities that you've both been looking at recently and what you've spotted in the last few months. But let's just take a moment to look at one piece of the AI puzzle. Our producer, Patrick Graham, spoke to US power sector analyst Shrishti Sinha about what the hard investment in data centres and the power they need means for the companies who have to deliver it.
So, Shrishti, you cover US power and utilities companies.
Yes.
What is going on at the moment?
So if you look at the last 2-3 decades, basically the US had something like 0.5% electricity demand growth. So now you have data centers coming in, and every 10 gigawatts of data centers adds 2% to US electricity demand. And then on top of that, you have reshoring, you have electrification. You're also retiring coal plants, building out renewables, hardening the grid against extreme weather events. So all of that coming together is giving you at least 2 to 3% electricity demand growth compared to the 0.5% before. Now you're starting to see contracts being signed for data centers that will start ramping in 2029.
But thereafter, everything is up in the air, or how do you think about that?
So it feels a little bit binary. If these models work, and if there's an ROI to AI, then presumably you keep building out data centers for longer as you replace more and more human labor with AI. If there is no ROI and these models stop getting better, then it's unclear if we'll need the full 50 to 60 gigawatts that's currently baked in out to 2030. I do think about how much data center we actually need. 60 gigawatts is a lot. Microsoft is out there saying they want to 10x the amount of training capacity every 18 to 24 months. But that's only as long as scaling laws hold up and you continue to see these improvements in the model.
Okay, so 60 gigawatts, but are there problems to that? Are there barriers to getting there?
Yes, absolutely. The different components you need are, one is all the chips, networking, memory, so just what goes into the data center. Then you have the electrical equipment and cooling. So that stuff is maybe a 12 to 18 month lead time right now. So we need something like 40% more electricians in the US just to build all of this out. So I think the biggest constraint right now that's determining the pace of the build out in many ways is the access to power. So you're starting to see these far more expensive sources of power getting pulled in just to get power more quickly. The last time you saw something like this would probably be the tech bubble in the 2000s when there was a massive gas build out, which did turn out to be a bubble. So a lot of the people running the gas turbine companies had lived through the previous cycle, so they're hesitant to expand capacity, which is sort of also constraining the pace of build out.
What percentage of the AI spend is going on this bit of it? We always talk about 500 billion a year at the moment. Is it half of it? Is it more?
So if you think about a typical data center that costs somewhere between 35 and 50 billion, maybe 70% of that goes to the chips, memory, and networking. Another 20% to electrical equipment, cooling, backup generation, and then 10% to the land, labor, and construction.
Do you think this is going to pop at some stage? What brings this all down?
Yeah, that's what we're all trying to figure out. So for the next 2 years, the outlook seems pretty set because all these hyperscalers are saying they're going to spend. And you can't fail before you've tried, and they definitely aren't going to give up on the AI race without at least trying. So beyond that, it depends on if there's a way to monetize this and what share of the 20 trillion US wages market AI can take over.
So that was power sector analyst Shrishti Sinha there, talking to Patrick Graham. Tom, that's Shrishti talking about the hardware of the AI story. What about the application layer? What have you been seeing there that's been catching your eye?
The story around AI has evolved from just being about the hardware and being very, very concentrated in a few stocks to being much broader and thinking about the applications of AI, because the cost is coming down, the effectiveness of using AI is increasing. And the companies where we're seeing that most, where they're applying AI most effectively, are in the advertising area. We've seen that just the ability to target ads more closely, to create ads that are more targeted for each tiny individual segment of the population rather than just big generic adverts, is leading to higher revenues for all the advertising companies.
And Fred, tell us about this from a European angle.
So I think when we're thinking about European technology, that's obviously a smaller part of the market than it is in the US. That being said, I think the way that you make money in stocks is really agnostic according to which sector you're in. So what I focus on is the cash that the companies produce and the likely rate at which they'll grow those cash flows over time. And actually, you have seen an interesting phenomena in some of the software companies where these stocks were seen over the last 10 to 15 years as invincible. And they've derated a lot. There are definitely competitive challenges that didn't exist previously, principally brought about by AI, by what AI may do to the business models of software companies and actually to the end users. If a large percentage of the labor pool is going to be replaced by AI technology, then probably you won't need as much software for the professionals who use those services. I guess the counter argument would be, if you substitute software for human labor, if you're an incumbent provider of that technology, you should have a chance at taking that market, and that could actually be a larger potential market in future.
Let's maybe take a step away from the AI story, because we're interested in some other opportunities that are out there. And I know that, Tom, you've just come back from a trip to the US where you were meeting with healthcare companies. What did you learn on that visit?
So we were on the East Coast on this occasion with our analysts, meeting a wide variety of different companies. And it's a fascinating time to be looking at them, because over the last year, since Trump came in, we've had this sort of regulatory backdrop that's been quite challenging. A lot of uncertainty. Valuations have sold off quite aggressively on the back of that. And at the same time, we're coming off a sort of a COVID peak where there was this huge investment in the sector. And now we're sort of working our way through the hangover, as it were, after the big party. And it feels like we're actually starting to see signs that companies are starting to come out the other side. And for us, that's really exciting. So we've got sort of a number of companies where we're seeing pipelines that are undervalued. We're seeing regulatory threats that are over sort of emphasized in the valuation. We're seeing loss of exclusivity for a number of drugs, but that's just led to stocks being pariahs rather than opportunities. And we're seeing some really genuinely innovative companies, which for me is very exciting.
What's the value add, do you think, from doing a trip like that compared to sitting in the office and listening to an earnings call or having a Zoom call?
It's fair to say that information now is very easy to get hold of. The value add comes from being able to see people in their home environment, as Fred was saying earlier, seeing not just the CEO or CFO, but seeing divisional heads, being able to dig into nitty-gritty, going on a manufacturing tour of a site visit to see where they've managed to eke out little gains and the way in which they're so focused on improving the profitability and the efficiency of that plant. Those sort of things you get a feel for from reading notes, but when you're actually there talking to analysts who've been covering these companies for years, who have deep knowledge, and talking to your colleagues who've owned them as well for years, you can really sort of improve your level of understanding, the depth of your understanding, and also therefore your conviction in holding these stocks and holding them well. I mean, if you take a contrast of a couple of CEOs, one who was very bland in terms of his understanding of what's going on in the politics, and another one who you can tell is very politically connected, has been spending a lot of time in Washington talking to the powers that be, negotiating his way through. And when you step back and think, right, which company is going to have a better outcome from this, I think it's quite clear one way or the other. And to put it in context as well, we sort of had a fork out and then came back together, and one of my PM colleagues was out in Washington at the start of the week visiting with lobbying companies and experts around Capitol Hill. And so in the evening, being able to sit around the table, have dinner with him, other portfolio manager colleagues and the analysts, and discuss his insights was, again, it's very pertinent and very easy way to get that information shared and to debate and bounce ideas off each other.
And Fred, anything similar for you? Any recent trips?
We recently went and met a European company that runs motorway concessions. And really, this is a company that's got a long history of investing capital and producing very, very attractive returns on capital. So each dollar they've invested in the business has produced good returns for the business and for shareholders. When you actually go and talk to them, the process that they go through in allocating capital is not revolutionary, but it's very, very thoughtful in terms of how they do it, and what each individual stage of that process is. And so building conviction, if you like, in something that's quite simple, which is the ability to allocate capital well, has enormous value as a fund manager. I don't think you get that just from being on a Zoom or listening to conference calls. You get a feel for it instead of going out and having a sandwich. If you're invited to someone's home for dinner, you'll probably learn more about that person than you will over a sandwich. The magic of conviction, I think, is created by that face-to-face interaction.
Okay, well, before we finish, I just have to ask you about China, Tom. You're a very experienced portfolio manager when it comes to Asian affairs and running money in emerging markets. We've seen the beginnings of a bull market in China this year. Where do you see that going?
In China, I think one thing that you've really got to ensure you're doing is, when you're investing, is you're aligned with the CCP, the government, effectively, because companies may have their competitive advantages, but if you're the wrong side of the powers that be, you're unlikely to be able to maintain your profitability. And I think it's become very clear over the last year or two that the CCP is very keen to have tech champions. So we went through this phase, if you go back 10, 15 years, where you had fantastic runs in the likes, in the bats, as it were, from China, the big tech companies. And then they were hit quite hard by regulation and the like. We're now in that phase where those companies are again being promoted by and being allowed to grow, being allowed to innovate, being allowed to build stronger competitive advantages. And that, I think, is really exciting, because these are genuinely innovative companies with scale, with the ability to grow. And we're starting to see that come through.
It's almost time to start drawing things to a close. Charlie, coming back to that question that we began with about looking for returns beyond US tech stocks, what are your key takeaways from the conversation we've had today?
I always find it fascinating to hear from our portfolio managers, because there's so many ideas bubbling up all the time. And I use the word bubble carefully, but this debate that I know our clients and asset owners are struggling with, is it a bubble or is it a boom? That is something that we spend a lot of time thinking about. And so there's opportunity there. These points of tension and uncertainty and volatility, they always provide us with opportunities to grow and invest in. So lots of areas to watch: European financial services, every different way to apply AI, and I know all of our portfolio managers are thinking about that. There's healthcare, there's China. I suppose my main takeaway is that diversification is still possible.
And the analysts helping with every step of the way as well. Well, look, before we head back into the office, we've got time to squeeze in a quick game of hot cakes, not potatoes. What asset would you grab quickly at the moment, and what would you offload fast to avoid any burns? Fred, I'm going to start with you for your hot cake.
My hot cake would be information services, which have seen a compression of multiples due to AI concerns.
Okay, and your hot potato?
Would be civil aerospace.
Why?
Valuations are very high.
And Tom, your hot cake?
My hot cake would be some select opportunities in the healthcare sector. That COVID hangover, valuations troughed out because of concerns around regulation. I think it's creating some great opportunities.
Excellent. And your hot potato?
Consumer staples, looking for very pedestrian growth, and they're not authentic goods. People just want something that's much more sort of close to home.
Excellent. All right. Well, thank you both very much. That is all we have time for. Thank you to my co-host, Charlie Wood, and to guests, Tom Record and Fred Sykes, and to analyst Shrishti Sinha. You can find out more on the topics we've discussed today on your local Fidelity website or at fidelityinternational.com, where you can also find our recently released 2026 Outlook, which goes into even more depth on what our investment experts expect in the year ahead, including a deep dive into the AI question. If you've enjoyed this episode, please share and subscribe. The producers today were Patrick Graham and Rachel Reed, with production support from Connor Bailey and Alex Wilcox. For now, from all of us at Fidelity, goodbye.